Well, good morning, everyone. I'm Jim Hall with Freddie Mac. I'm here with my business partner and good friend, Lakeisha White from New Jersey Housing. And we really want to thank, NCJAR for, inviting us to speak with you today. Hopefully you'll find the information that we have, valuable. And also, this session is going to be recorded, and it will be on their website. And also, you'll be getting a copy of my presentation and Lakeisha's slides also. So don't feel that you have to write everything down and jot down notes, and you'll be getting a copy of all this information. So let's get started here. Again, I'm Jim Hall. I'm an affordable lending manager with Freddie Mac. I've been with Freddie Mac 5 years now, and I focus on relationships with realtor associations like yours, housing finance agencies like New Jersey Housing, and lenders. And what I do is, help with business development strategies to penetrate the lower to moderate income markets. If you ever need to get in touch with me, my email address is on this slide here. It's james_hall@freddiemac.com. Feel free to reach out to me at any time, and I'll try to, answer your questions or point you in the right direction. I've been with Freddie Mac in this position for 5 years. Prior to that, I worked in Trenton at New Jersey Housing, as a matter of fact. And prior to that, I worked at many private lenders throughout the state of New Jersey. I'm located in Burlington County, a town called Delran. If you're familiar with southern New Jersey, I'm near Cherry Hill, Mount Laurel, and Marlton, in that area. But I have worked up in Union County and up in Roseland at times also. So I'm very familiar with North Jersey also. Let's talk about Freddie Mac. Okay. A lot of people hear the name but aren't really sure of what we do. It is an organization. It's not some Irish dude named Frederick McGillicuddy. So the name catches people off guard. We've been around for 52 years. We were chartered by Congress in 1970. We're what's known as a government-sponsored enterprise. The acronym used in our industry is GSE, and we operate in the secondary mortgage market. So we're a mission-based organization, and our mission is to promote liquidity, stability, and affordability in the housing markets. We also have community missions, and those community missions, stabilize communities. And one of our main community missions right now is to bring equality in lending. We're trying to bridge the home ownership gap between white Americans and Black Americans and Hispanic Americans. And we're doing that by partnering with associations like yourselves, housing finance agencies, and lenders to make sure that we can present home ownership opportunities to everyone. We have 3 main business lines: single family, which I'm part of, and we define single family as 1 to 4 unit properties, and multifamily division also, which is 5 units and above. And we also have our capital markets division, which controls the money. And that goes back to one of our main parts of our mission, providing liquidity into the marketplace. We have 4 main business pillars: insights, mortgage products, education, and business solutions. And I'll touch on all of them during our discussion today. We're headquartered in McLean, Virginia, and we have a tremendous data analytics department, which provides a lot of information for us to share with associations like yourselves and our lending partners and our housing finance agency partners. We have many mortgage products. I'm going to discuss one specifically that lenders use through housing finance agencies in a few moments. And we also really pride ourselves in education. And that is, industry education and consumer education. We do events, we do training, We promote financial literacy, and we're not afraid to speak with the public also. Lakeisha and I have done many webinars throughout the year, talking to consumers and really encouraging them, to become homeowners, but just not to become a homeowner, but to know how to become a homeowner. So education is very important for all of us, whether you're a realtor, an agent, a lender, or working in a housing finance agency or working at Freddie Mac, because we're all working together to help the client here. We have a fiduciary responsibility to them to provide the most affordable home that meets their needs, and also to provide the most affordable loan programs that they qualify for. We also have many business solutions, and when I wrap up my discussion, I'll go over some resources and tools that Freddie Mac provides that hopefully you'll find value in. Please keep in mind, Freddie Mac does not sell anything. We're a provider, and being a government-sponsored enterprise, we have the capability of being out there in the marketplace and helping every facet of it, whether you're a realtor, a housing counselor, a lender, or a housing finance agency. We look at all areas within this industry. And we try to capture that on this screen here. This is always one of my favorite screens. There's many hands involved in a real estate transaction and a mortgage loan application. And we call it the affordable ecosystem. And you as a real estate professional and also loan officers are at the beginning of the transaction. I like to use a biblical term and say, you're at the genesis of the transaction. And that's why we put yourselves and loan officers at the top of this affordable ecosystem, because the customer comes to you first. And the more educated you are to help them out and to become educated, the better they're going to be. So we need to get them off on the right foot. And then all the other bubbles there, come into play. And we don't want, consumers going into anything, in a blind fashion. So you see housing finance agencies are there at the bottom of the ecosystem. I mentioned Freddie Mac, we're a secondary marketing company where we purchase loans and provide liquidity. Housing finance agencies do the same. They work as like smaller Freddie Macs. So again, they are an important piece of the affordable ecosystem, as everybody here that is listed. And like I mentioned, you'll be getting a copy of these slides. So, please share them with your colleagues and share this information with them after our webinar here. So let's talk about housing finance agencies. They're near and dear to my heart. Like I mentioned, I was assistant director at New Jersey Housing for 12 years, from 2006 to 2018. And sometimes they're a hidden gem. People in the industry aren't really sure what they do, but they've been around a very long time. In the mid-1960s, when Lyndon Johnson was president, his vision for America was called the Great Society. And Johnson is most famous for signing the Voting Rights Act and the Civil Rights Act in the mid-60s. But a lot of people don't realize he signed the Fair Housing Act in 1968. And within the Fair Housing Act, the whole focus on that was really a major affordable lending and housing component. And Johnson's administration knew they couldn't do it all at a federal level. So they took it to the states like New Jersey and said, we need your help. I mean, you're the subject matter experts in your area that know where the lower to moderate income people are, and they're going to need the housing and the lending programs that we're going to create and promote. So with that, housing finance agencies were created through the 1960s, 70s, and 80s. And New Jersey Housing, actually New Jersey had two agencies that were created in 1967 and 1970. One was the housing agency, and one was a mortgage agency, and one focused on multifamily and one focused on single family. And they were consolidated together in 1984 to be the New Jersey Housing and Mortgage Finance Agency. And they've done, tremendous things in the state of New Jersey for many, many years. And other housing finance agencies throughout the country, have delivered more than $600 billion in financing for, new housing and rental units for, over 8 million affordable homes, which is a tremendous, tremendous achievement. And then, and that is one of the reasons why Freddie Mac partners with housing finance agencies, because they're mission-based and they're serving, the very low and moderate income households throughout the country. So what type of opportunities do they provide for you? If your lender is not, using, the programs that a housing finance agency provides, number one, ask them why, because, they really should be aware of what these housing finance agencies offer, to the consumers. One of the main things that they do is they provide low down payment options and down payment assistance. And as we know, the millennials who are coming into the marketplace right now, a lot of them don't have a lot of cash assets. And New Jersey Housing can really, really, supplement, that issue and help them with the down payment and closing cost assistance, to get them out of the renter ranks and into, the home ownership ranks to where they can, partake in, attaining the American dream of home ownership. So Freddie Mac, again, like I said, we looked at the housing finance agency market, and we really saw that, they are the perfect partner for us. So we created the HFA Advantage program that is lenders use exclusively through housing finance agencies. And I'll touch upon that. And Lakeisha can go into a deeper dive later to really, really, button it up on really what New Jersey Housing offers through this program. Because what we do, we put this program out there, and then the housing finance agency, has their own guidelines and uses certain components of it. So essentially, it's a 3% down program, and which is better than an FHA loan, because FHA requires 3.5% down. And with that, we also have charter level mortgage insurance for consumers that are at 80% area median income and below. So what that does, it really helps them out from an affordability standpoint. So again, it gives you more flexibility when it comes to offering loan programs to your consumers. So we're not trying to turn you into an underwriter or a loan originator. This process here, we're just trying to raise awareness so that these programs are out there in the marketplace. And again, it helps us all, to perform that fiduciary responsibility that we have, to the prospective home buyer. HFA Advantage has to be underwritten through our automated underwriting system, which is called Loan Product Advisor. The acronym that's used out in the marketplace is LPA. Some people shorten it to LP. So this is a nice side-by-side comparison here on why HFA Advantage is a better alternative than an FHA loan to the applicants to qualify. An FHA loan, the mortgage insurance stays on for the life of the loan. It's perpetual. It doesn't go away. With HFA Advantage being a conventional loan, the mortgage insurance sunsets and may go away once the loan-to-value ratio goes below 80% and hits 78% loan-to-value. As I mentioned, we have charter level mortgage insurance, which is reduced, and that's the only payment they pay is monthly. And FHA has that costly upfront premium, which costs thousands of dollars to the consumers, And then they have that monthly premium, like I mentioned, is perpetual and stays on for the life of the loan. So really, it's a great alternative. And I'm not here to bash FHA loans. They have an important part to play in the affordable ecosystem. But if your consumer qualifies for the HFA Advantage loan, it is a better deal for them, and you'll save them money. And I included this screen here, and I know there's a lot on here, but I just don't want you, to hear, this talking head on your computer that's saying, okay, this program is better than this program. Here's some numbers here that back up what I'm saying. So, after the webinar, like I said, you'll get a copy of this, take a harder look at it. But the bottom line is, if you look in the left-hand column, the potential 5-year savings on the conventional loan versus the FHA loan is over $9,000. So it really, really can help that, first-time home buyer, because $9,000 over 5 years will go a long way to, really, really help them, meet their needs. And I wanted to illustrate to you these savings for the charter level mortgage insurance, because again, a lot of people, haven't heard of this. So if you look in the first column, okay, that's mortgage insurance for borrowers with at 80% area median income or less, okay? And what we did, if you look at the top box, okay, for 95% to 97% LTV, we've reduced the coverage to 18%. And if you look to the right, when standard conventional loans at over 80% area median income, the coverage is 35%. So we've cut the mortgage insurance down almost in half, which will be a substantial savings for the consumer. And here's a tool for you. You can go to this web page and bookmark it, and it has all the details for the HFA Advantage program. So it's nice to have, as a resource. So that's why I included this in here for you. And like I said, you'll get a copy of this, of these slides, so you'll be able to, actually, go in and type in a HFA Advantage to the Freddie Mac website, and it'll take you right there. Also, as a resource, we have the HFA Resource Center. This is a nice site that we developed that has a lot of information that just pertains to housing finance agencies. A lot of good information on there. So, please take a look at that and see if it meets your needs, and bookmark that page also. And I'm in the stretch run here before I turn it over to Lakeisha. And I wanted to go over some more important tools for you. My Home, if you're not familiar with this, again, the website is in the bottom right-hand corner, myhome.freddiemac.com. It's a website for consumers to use that gives them a lot of information on renting and home buying and the process. So, it's not our intensive website. It's more of, the first step to, getting into the process. And then once you've really, really, have that consumer, really, really, fighting to become a homeowner, you've identified, the proper house for them to go for, you can really start them through the education process with our more intensive program, which is called Credit Smart. Now, Credit Smart's been around for, over 20 years, and it's a great financial, literacy tool that it's multiple modules. It's not, something that they have to do in one sitting. This is something that your home buyer can really, really focus on and keep for the rest of their lives and help them through the home ownership journey. Now, I can tell you that, a lot of millennials right now, I mean, they were born into the technology. And, I have a 26-year-old daughter and a 29-year-old son. And my son went through the home buying process last year with his fiance. And I really got educated on how they obtain information. I sat down with him. I said, okay, your pop's been in the industry for 36 years now. I can help you out. I can find you a great realtor. I can find you a great loan originator. And he's like, well, Dad, I'm a self-starter. I want to do my own research. I said, well, how are you going to do that? And he showed me his phone, and he was getting information through YouTube, TikTok, and Instagram, which really opened my eyes up. And my daughter was sitting at the table with us, and she said, yeah, Dad and Mom, YouTube is for old people. And I was like, okay, that's nice to say to your parents. But, and they said, well, really, a lot of our friends are looking through these other, social media outlets to gain information. I said, well, that's important knowledge. I said, in our industry, if you have to speak to all generations. So, just some words from my household. If you aren't marketing yourself on, those three websites or social media engines, you may be losing out on some potential deals. So again, my son said it was YouTube, TikTok, and Instagram. And I'm not saying, take yourself off YouTube, because there's people, my age and Gen Xers that are still buying properties. So you just want to make sure you're saturating the market. And with that, I did convince him and his fiance to go use Credit Smart, which they found to be very, very, interesting for them. And they said it really, really helped them out because, they're not being taught how to budget and handle accounts and things like that in high school anymore. I had that when I was in high school back in the 1970s. They taught us how to, use a checking account and, how to pay an electric bill and how to pay a water bill. And that's very, very important. And Credit Smart will help out the prospective home buyer with that because, we get caught up in just getting, them qualified for a mortgage. Can they make the mortgage payment? Well, there's a heck of a lot more than just making a mortgage payment to being a homeowner. Once you as the realtor gives them the keys and they open that door, they got to buy furniture, they got to buy drapes, they got to buy curtains, they got to buy a lawnmower. They need a rainy day fund in case something happens that they can, go and use that money and take care of, some type of need that arises. So please, take a look at Credit Smart after this webinar, and please recommend it, to your prospective home buyers because it's free. It won't cost them a dime, and and it'd be great for them to use and have as a tool, through their home ownership years. Part of Credit Smart, we have Homebuyer U, which is it's 6 modules that focuses specifically on home ownership. And again, it's self-paced. It's in English and Spanish. And the great thing about it is they have to pass a quiz at the end of the 6 modules, and they obtain a home ownership certificate, which is nationally recognized as, passing a home buyer education course. New Jersey Housing accepts that certificate for this program. And again, it doesn't cost anything. And it is a great course. So, please take a look at that. And also, we developed the Real Estate Professional Resource Center for you as realtors to use. It's a great online source for you to learn industry trends, get, key information and topics that will help you develop your business plans and help you empower your clients. So please subscribe to this. Freddie Mac will not spam you. Again, being a government-sponsored enterprise, we're only going to share relevant information with you that will really help you, with your day-to-day planning and activities. And if you can take a moment and get your cell phone out, and if you can scan that code there, and after Lakeisha is done with her presentation, if you wouldn't mind, taking our survey. We need your input. That's how, we get better as, as presenters. And also it's how we, craft our content to make sure that you, feel that it is important, it is valuable, and that you did get something out of this, this discussion. So again, if you don't have your cell phone ready, you'll get a copy of this presentation. You'll be able to scan that code once you get these slides. So with that, I want to say a big thank you. We will, after Lakeisha speaks, we will monitor the chat box if you have questions in there, and we will, open up the discussion. So I'm going to stop sharing my screen right now so Lakeisha can share hers and do her presentation. And thank you very much, Lakeisha. The time is yours now. It's always great, partnering with you on these presentations, and I know you're going to, share some tremendous information also.
Good morning, and thank you, Jim, for that warm introduction. And I do appreciate your partnership that we have with Freddie Mac, and we also appreciate the partnership that we have in being able to present this great information to realtors. And so, as Jim said, my name is Lakeisha White. I am the Manager of Business Development for New Jersey Housing. And so one of the things that we do have the pleasure of is being able to do these phenomenal presentations with realtors, with lenders, other community stakeholders, and business partners. And so, as Jim did share, the presentation materials that I am going to be reviewing today, that information will be shared with you. And so don't worry, don't feel like you have to write down everything, but in case you're not familiar with who New Jersey Housing is, we are the state's affordable housing agency. And so we provide opportunities for New Jersey residents to achieve the dream of homeownership by implementing a creative suite of programs. The programs that we will be discussing today, you can't call me directly and say, Lakeisha, I want my client to use this program. They do need to go through our network of lenders. And so we have programs available for first-time home buyers. We also have programs available for individuals who contribute to our police and firemen's program. And then more recently, we have a program that is called our IRMA program, which I'll just share about briefly. And this is for New Jersey residents who are homeowners who may have had a reduction in their income or negatively impacted by COVID, and it resulted in them falling behind in their mortgage, where they can get up to $35,000 for assistance. So I will show you how you can find all of our consumer resources available to share with your clients. And so what our mission is, of course, our mission is to help advance the quality of life for residents of our communities throughout the state of New Jersey. And that includes investing, financing, and facilitating affordable rental housing, homeownership opportunities for low to moderate income families, older adults, and individuals with specialized housing. And so we do realize as an agency that when home buyers are starting the process to initially buy a home, they're not thinking, let me reach out to New Jersey Housing. And so that's why it's so important that we get the information to realtors, to community stakeholders, so that when you are doing your buyer consults, when you're meeting with your partners, that our programs become a solution that you can see as a right fit for your clients. And so today I'm going to be going over how through our programs, borrowers can get up to $15,000 for down payment and closing costs to purchase new homes. And remember, if your clients are interested, they're not going to apply directly with me. I'm going to give you some key pieces of information on what they can do to get partnered with our lenders. And so our first mortgage program that we do have available, we have our first-time home buyer program and our Homeward Bound program. Those are our government mortgage programs. And so the first mortgage can be FHA, VA, or USDA. And the HFA Advantage program, which is a program that Jim Hall just talked about briefly, and that's a conventional mortgage program. Those are our foundational mortgage programs, and they can be combined with our down payment assistance program. All of the mortgage programs are 30-year fixed rate mortgage programs. And so the rates for the program, they are set by New Jersey Housing. And so it doesn't matter if your client has a 620 credit score or if they have an 850. Everyone gets the same interest rate because it's set by New Jersey Housing. And so it's a level playing field. And so one of the things that I'm excited to share is that our programs and our rates, they are competitively priced. I would say, given what's currently going on in the mortgage industry, some of our partners, our lenders are finding that our rates may be more competitive than theirs. And so our list of participating lenders has been growing weekly. And so our programs are available to eligible borrowers who qualify. They have to meet the agency's requirements as well as the lender requirements. And so the lender has to be able to get that FHA, VA, or USDA approval if it's a government insured loan, or if it's our HFA Advantage program, that's following Freddie Mac guidelines. And so for our government mortgage programs, these are the borrower requirements. The borrower must be a first-time home buyer. Now, how we define that as is someone who has not had ownership interest in a primary residence during the previous 3 years. Now, for our first-time home buyer program, this is our program that has a little bit of a lower income limit, and I'm going to share that with you in a moment. But that program, the first-time home buyer program, we do have 2 exceptions to that first-time home buyer requirement, is that borrowers of homes who are purchasing homes in urban target areas or qualified veterans, they do not need to be first-time home buyers, but they must not own another primary residence at closing. And so for our first-time home buyer program, the first mortgage can be either FHA, VA, or USDA, and the DTI requirements for that is a front end of 40, back end max of 47%. But your key portion of it, of course, is getting your clients partnered with one of our lenders, and they're going to be sure to qualify them and fit them into the right program based on their DTI and their income. Also, for these programs, the minimum credit score requirement is 620, and then that's for all the borrowers. And then borrowers must not possess enough liquid assets to close a loan at 80% loan to value or less. And what that simply means is your clients cannot possess more than 20% of your purchase price, your prepaids, and closing. That does not include the 401k or pension if they would incur a penalty to withdraw it. And so I'm going to share with you, this is our first-time home buyer program. This is a handout that is going to be shared with the information that you'll be given today. And so this is just a nice consumer fact sheet that you can use for your buyer consults. It just has all of the information here that I just went over, so you don't have to remember it verbatim. And then you'll see here where I talked about how borrowers can get up to $15,000 for our down payment assistance. It is based on the county of the purchase property. And so you'll see for Bergen, Essex, Hudson, Hunterdon, Mercer, Middlesex, Monmouth, Morris, Ocean, Passaic, Somerset, and Union. For those in those counties where borrowers are purchasing homes, they can get $15,000 to be used for the down payment and the closing costs. And then for the remaining counties, it is $10,000. And so for the most part, it's primarily going to be the statewide income limits. And so I'm just going to use, just as an example, Mercer County, because the agency is located in Mercer County. And so for a 1 to 2 family, the household, the max income limit is $106,800. For 3+, it's $122,820. And it's simply just based on the lender asking the borrower how many people are in their household. One of the key changes that we did make about a year ago is that the household income is only based on the income of borrowers, co-borrowers, and mortgagors. We no longer require all the income of all adult household members. The other program option that the lenders will look to qualify your clients for is our Homeward Bound program. This is also a government insured program as well, where the first mortgage can be FHA, VA, or USDA. And so these income limits are higher, you'll see. And I'll just use as an example again, Mercer County. And so the max income limit is $149,520. What you'll notice here, though, for the Homeward Bound program is that the purchase price limits are going to be your standard FHA, VA, or USDA limits. Whereas with the first program, the first-time home buyer, there are max purchase price limits. And so you'll see, even though, we are the state's affordable housing agency, there is a lot of wiggle room based on the income limits for a lot of people to take advantage of our programs. And so the eligible properties for our government mortgage programs, and that would be the first-time home buyer, Homeward Bound program. Of course, the property has to be located in the state of New Jersey. It can also be used, like if you're working with a client who's moving from New York to New Jersey, they can also use our program as well. The property must be a single-family home, condo, townhome, manufactured or mobile home, but it must be one where it's affixed to the foundation and there's not a monthly lot fee. And then, of course, new construction. Our program can also be used for a 2 to 4 family dwelling unit that it must have been in existence for at least 5 years, and the borrower must live in one of the units as their primary residence. And so this is a great opportunity for if you have a borrower who wants to be able to create some generational wealth. When you buy a multi-unit, the lender can use the additional income from the rental units to be able to qualify the borrower for more, and it doesn't count against them in using our program. And so typically when you have a situation like that, the one unit can cover the mortgage, the additional units can be used for the borrower to save or invest. And then, of course, in our urban target areas, when using our first-time homebuyer program, there is the opportunity for higher income limits. And so you'll see here, you'll also have this handout. These are the areas identified by HUD as urban target areas, and it may not include the entire municipality. So if you get a sales contract and you notice it's one of these areas, you definitely want to let your lender partner know that you are working with, that could possibly, borrower could qualify for that part of it. Our other program that Jim talked about, this is our new conventional mortgage program, and we launched this program almost about 8 months ago. And this is our conventional HFA Advantage mortgage program. What's great about this program, of course, is that it offers a reduced mortgage insurance premium of only 18%. And so that is a big win for a lot of home buyers to help them qualify for more. There are no loan level price adjustments, and it can be coupled with our down payment assistance program. For this program, even though the minimum credit score requirement for our programs is 620, what we have seen is that lenders have only been able to get that LPA approval, the Freddie Mac approval, if the borrower has a credit score that's closer towards 680 or higher. Then the other thing is on this program, the DTI is just a back-end max of 50%. Now with this program, the income limits cannot exceed 80% of the area median income. And this program does allow, if you have a client who wants a conventional program option, they have a very strong credit score, they meet the income guidelines, and I'm going to go over in just a moment, but maybe they're not a first-time home buyer. They can use our HFA Advantage conventional program as a standalone product. But again, if they're looking to use our down payment assistance, then of course they do need to be a first-time home buyer. And so for our HFA Advantage program, you're also going to get this great handout. You'll see here for each one of the handouts, we do have listed on there the counties and the DPA amount. But with the HFA Advantage conventional program, I'm just going to use as an example, again, Mercer County. The income limit is $95,360. And then you'll see there are no purchase price limits because the lender's just going to follow Freddie Mac guidelines for the purchase price limits. And so the eligible properties for this program, of course, has to be in the state of New Jersey. Again, if you have a client that's moving into the state of New Jersey, as long as they meet the requirements, they can use the program. Must be a new or existing single-family home, condo, or PUD. Currently, we are not allowing for multi-units, co-ops, or manufactured homes for this program. Now, one of the great things about this HFA Advantage conventional mortgage program is that it may be eligible to be used for some affordable units. We just have to ensure, the lender would need to work with the agency to ensure that there isn't anything in the deed or covenants that conflicts with Freddie Mac guidelines or the agency guidelines. And so this is one of the great things about this conventional program is that it can be used for an affordable unit. And so why you would want to have your clients use our program. We provide up to $15,000 towards the down payment and or the closing costs. And again, it's going to be based on the county of the purchase property. And so typically what happens is lenders will take the first portion of it, use it towards the down payment, and then the remainder will be used towards the closing cost. I've listed there for you the counties where it is $15,000. The DPA is a forgivable loan, no payments and no interest, and it has to be coupled with one of our first mortgage programs. So if the borrower is looking to use our DPA, they also are going to work with the lender to get the first mortgage from the agency lender as well. And so again, first mortgage can be either FHA, VA, or USDA for the HFA Advantage conventional program. The great thing is if you have a client that qualifies for VA or USDA, we know they can get eligible financing up to 100%. And so as long as the borrower resides in the home as their primary residence for 5 years without selling, refinancing, or defaulting, the DPA is completely forgiven. Borrowers still can also use a seller concession. So they can use a seller concession if there is additional money. So we do allow for a max cashback of $3,000. So borrowers can get back, money from an EMD for appraisals, inspections, and things like that. If there's still excess money, then the lender can do a principal reduction to help pay down the borrower's mortgage. And so again, it is available for new construction. It's very important you tell your client stay there for 5 years. And in using the DPA, they do have to be a first-time home buyer, meaning that they haven't owned a primary residence in the last 3 years, or if they're a qualified veteran or purchasing in the urban target area, they can use our first-time home buyer program and avoid that first-time home buyer exception if they meet the guidelines. One other key requirement, of course, borrowers do need to complete a HUD-approved credit counseling course. It doesn't matter if it's in person or online. And if you have a client that says, I already did, a course already, those certificates are good for 1 year. And then the Smart Credit course that Jim spoke about, that program meets the requirements if your client's using the HFA Advantage conventional program. And so one other thing that I do always like to share, this is not the agency's website, but this is a good resource for you as a lender, is the Down Payment Resource Group. This is where you can learn about other down payment assistance programs. And so borrowers can use our down payment assistance and other DPA programs as long as they'll go in third lien position. And so this resource here is a great way for you to plug in the purchase property address and see what programs are available. And so I have that link there for you. And I'll just see if there's any questions in a moment. And then this is the contact information if you'd like to get more information, learn more about what we have going on. We also are going to be an exhibitor at Triple Play, so be sure you stop by our booth. And then the other thing I'm going to share with you, and I'm going to put this link into the chat box because this is a link that you want to be sure that you hold on to if you do have clients who are interested in our program. Maybe when you look at our list of lenders, we do have our full lender list information here. We have all of our program information here. If you have a lender you already partnered with them and they're on our list, then let them know you want to use our program. But if you have clients that want to use our program and you don't have a lender, we do have a lender request form where they can fill it out. We'll send them the list. Once they fill this form out, we'll send them the names of 3 different loan officers, their email address, contact information, and that way they can get partnered with a lender that's very well versed in our programs. So I'm just going to put the link for this site into the chat box. And again, thank you, Jim Hall, for inviting me to speak with you. And also thank you to NCJAR and their staff for allowing us just to share this great information.
Well, thank you, Lakeisha. Great information. And we'll open up the chat box now and see what we got in there. All right. There was a question on how do I find this on YouTube? So if you came on late, this presentation is going to be recorded and NCJAR is going to be placing it on their YouTube channel. That's correct, right, Ella?
Yes, and on our website as well. So I will let everyone know once I have uploaded the recording, and I will be sending the link as well to the recording.
And you're also sending
the slides as well.
The slides. Yes. Okay.
Yep.
All right. Okay. And Lakeisha, there's a question in here. Is this for urban target areas?
So our program is available statewide. So it's not just for urban target areas. I did reference urban target areas. If you have a client who possibly owned a home before, but they don't currently own a primary residence, if they're buying in an urban target area and they meet the qualifications for one of our programs, they can purchase again. But our program is available statewide. So your client can buy a home anywhere in the state.
Okay, great. And there's another question, Lakeisha here says, what is the difference between HFA versus FHA?
Okay, so the HFA Advantage program, it's a conventional mortgage program following Freddie Mac guidelines that Jim spoke about. I also shared about it. It can be coupled with our down payment assistance if your client's looking to use our DPA. The other part of it is it can be used as a standalone product. What's great about this program is it's just 3% down payment, 18% mortgage insurance, which is different than FHA. We know FHA, you have to put down, which is a government insured, you're putting down 3.5%. You know, the PMI is on much longer. And so if you have a client that has a strong credit score, and typically the lenders are able to get an approval of if the credit score is 685 or higher, if they have great reserves and they have that strong credit score and meet the income guidelines, then we always say that the HFA Advantage is a good fit for them. But one of the things that you just want to, be confident in knowing, whether your client uses our lender referral form and they submit that to get lender information from us, or if you have a strong partner who does offer our programs, when your client meets with them, they're going to fit them into the program based on what's best for them. And so that's what you always want to be, rest assured. You don't have to kind of stress yourself and saying, I need to know this, this, and this. Get a strong lender that works with our programs, and they're going to be the ones that's going to fit your client into the program. And if you have questions, reach out to us and we can go from there. We've had some realtors that learned about our program and then the lender was new to working with our program. So we work through that. We help your lender help you.
Yeah, and keep in mind, going back to the mortgage insurance, that an FHA loan has that massive upfront mortgage insurance premium, which is usually thousands of dollars. And at one slide, I illustrated that on the cost comparison. So, please take a look at that when you get the slide. You'll see the major difference. And then, as Lakeisha also mentioned, that FHA, the mortgage insurance payment doesn't go away. It's on for the life of the loan. On a conventional loan, the potential is there for it to go away once the loan to value ratio hits 78%. There's another question in here. Lakeisha says, can everyone apply for an HFA Advantage loan? I guess you want to address that by pointing them to the right lenders that are approved with New Jersey Housing.
Yeah, so that's going to be important. I did put the link to this site. And here's the information here. Oh, am I sharing my screen? Can I share again? Can I share my screen? Is that okay? I just want to show this to everyone.
Yeah, okay. I believe you can.
All right, so I did put this link into the chat, and this is our consumer page. Also great for realtors to use as well. This is the information about our HFA Advantage program. Here is also the list of lenders who currently offer the program. And keep in mind, you can just have your client do our lender request form, and then we're going to send them information for lenders who are well-versed in our programs. So if you don't have a partner and you're looking for one, easiest thing for you to do is direct your client to fill this out. Once, if someone completes it today, we will send a response by the afternoon. So each business day, we send out the information to prospective borrowers twice a day. So be sure you save this to your favorites, because if you don't have a lender that you already work with, just send your clients here. This way, if you're looking at the full list, I can't make any guarantees that you'll get partnered with someone that's very knowledgeable, but we do know that the lenders who are part of our referral program, they are knowledgeable about our programs.
Okay, Lakeisha, looks like there's a question in here regarding the speed of the process. The question is, how fast can an HFA Advantage loan get a buyer finance? I have a client in the process of funding and needs this like today. Consider to fund the home. It would help, it says. Okay. I don't know if you can get it done today.
It wouldn't happen today, but I can tell you that we do have seasoned lenders that can do our closings in 30 days. The way that the process works is the lender does all their normal due diligence with the mortgage process. And then once the file is cleared to close by the lender, they submit the file to the agency for review. We're just doing an income and compliance review to make sure that the borrower meets the requirements. Lenders should submit the file electronically to the agency at least 5 business days before the scheduled closing date. So we do have some lenders that they are well versed in our programs and they've done 30-day closings. I can't guarantee that's the experience for all, but we do have lenders that do that.
Okay, great. And there's another question in here. Is there an HFA cap on funding like FHA cap guidelines?
Are you talking about the purchase price or the income?
I don't know. Let's see, who is this from? It's from Mitchell. Mitchell, are you still on the line? Can you just unmute yourself and let Lakeisha know what specifically you're asking there?
How you doing, Lakeisha? It's Freddie.
Hi.
Mitchell. Good. I'm just asking, I had a client, that was my previous question as well. Is the FHA cap, because it's 3.5%, some of the lenders are switching their programs at the last minute before closing within like maybe 15 days. And they're going from a 3.5 FHA to a conventional. Now they're charging 5. They're have to go back to the bank to get additional funding. And I have that situation right now with a client, because there's a referral, but I had him as a New Jersey resident. He may not qualify for this, but just seeing if there's an FHA cap, because the FHA cap was $420 in the county, and he had a purchase price around $415. But then when he switched to conventional, now they have to bring more money to the table, and we already passed attorney review and everything like that. By having a HFA at 3%, if they were in New Jersey, is there a cap for each county? Because in Martin County, it's $970,000 on a single family, and Warren County could be $420. But due to those caps, is that same requirement the same for the HFA, following FHA rules under Freddie Mac?
So the lenders are, yes. So the lenders are going to follow Freddie Mac guidelines for purchase price limits, and so there are going to be caps for each county, and so. What the specific limits are, I don't have them, but I can get the link and put it in there for purchase price limits. But keep in mind with our program, because it's generally it's 80% area median income, we haven't seen very high purchase price limits with the HFA Advantage program because it is geared towards low to moderate income, and so that's just something you may want to take into account. Our Homeward Bound program, which does allow, it's the same thing following FHA guidelines in terms of purchase price limits, but that may be a better fit for someone if they're looking to be able to get higher purchase price limits. What we found more recently with the way that the industry is and the rates are, a lot of lenders are right-fitting borrowers to use our programs because our rates are more competitive than their standard FHA rates that they're offering right now.
Thank you.
Okay. All right. There's 2 questions in here which we already answered. One was, where can I find an HFA mortgage rep? Lakeisha went over how to find a lender with them. And then also, are we getting the slides? We answered that yes. Ella answered that and is going to be sending them out to you. Then there's a question, are you currently working with buyers? Well, if that question is specific to home buyers, I know Freddie Mac and New Jersey Housing doesn't work, specifically with the consumers. We leave that up to you, the realtors and lenders, to have, direct contact with the home buyers. So we're not in competition with our realtor partners or lender partners. Another question for the realtor. How can we find out the lenders? Okay, so Lakeisha already handled that one. And Lakeisha, there's a question in here. Is a TIN ID adequate to use for applying?
If they are a permanent resident or resident alien, we know about a year and a half ago that FHA changed their guidelines for DACA recipients. DACA recipients can use our program. So if you would just need, the lender's going to again be the one to work with them and qualify them, but DACA recipients can use our programs, permanent residents, and they can use our program. But again, they're going to work directly with the lender.
Okay. And there's a question in here. Does the 18% mortgage insurance coverage, is it based on the house price? So no, the 18%, to qualify for that, you have to be at 80% or below area median income. So that's the trigger for that. And that is at between 95 and 97% LTV qualifies for the 18%. And it actually goes down, if you recall the slide that I presented, if the loan to values are less, then that 18% actually does reduce. Then there's another question, do the insurance premiums disappear once the loan is prepaid? I'm not sure how to answer that question. If the loan is prepaid, I guess the question is being paid off. Pearl, you had asked that question. Can you clarify that? Are you still on the line?
Yes. There is no prepayment penalty anyway in New Jersey. So if you get a loan and you prepay throughout the time, you shorten the length of the loan. My
right.
Is that with the FHA and with this HFA, right? Okay. So let's say a person diligently prepay a few dollars every now and then, and the loan close up in quicker time. Are these two agencies going to like, hey, guys, you committed this never go away, like in FHA, right? This is not a one time, the life of the loan, right? That
right.
Do they? I mean, can they come back to you and say, you committed to this, even though you prepay? Yeah, there is no prepayment penalty in the state.
That's correct. And once the loan is paid off, the mortgage insurance is gone because the loan's gone, and the mortgage insurance isn't insuring the mortgage anymore. So, so to answer your question, yes, once the loan is paid off, the mortgage insurance is gone at that point also.
So that's fine. That's one good way to bypass the 18% this highway robbery insurance charging on people. You're talking about fair housing. Well, reduce the stupid rate. 18%, that's a lot of money. We cannot sit here and brag about fair housing when we are charging people like that.
Yeah, but it's not an interest rate that's being charged. It's just the amount of coverage that's being charged.
About the interest rate, I'm talking about a premium expense.
Mm-hmm.
And on one hand, and say we're trying to help you, and another hand say, hey, by the way, 18% service charge, whatever. That's what.
Okay. All right. Well, thank you for your comments.
That is one good way for all realtors to encourage people to prepay. Forget about going to AMC Theater and spend $100 for a family to just see a movie. Prepay your mortgage.
Okay. All right. Well, thank you very much. All right. The next question, Lakeisha, does the lender need to be located in the county the property is located? What should we take into consideration when picking the lender from the list?
So for the lender request form, if you're directing your borrower to go to our site and complete this form, it does ask them which county are they looking to purchase a property. And so it is going to provide them with the list of lenders that cover that area. What's great about that, of course, is because they're knowledgeable about what's happening in that specific area where your client is looking to purchase a home. But if you are a realtor that partners with a lender that's in a different county and you're accustomed to working with them, as long as they work for a company that's on our list of participating lenders, it's fine if you work with them.
Okay. And Lakeisha, another question here. Can you be considered a first-time home buyer even if you already have a property?
So with the program, if the borrower is looking to use our down payment assistance programs and use our first-time home buyer homeward bound program, they must not have owned a primary residence in the previous 3 years. With the HFA Advantage conventional program option, they can use that conventional program as a standalone product, even if they don't meet the first-time home buyer program requirement. But the other option is if your client's buying in an urban target area, they can use our program as long as they don't own a primary residence at closing. So there's some what ifs and some other scenario related questions to that.
Okay. And another question here, Lakeisha, is if they have student debt, would that disqualify them?
So having student loans does not automatically disqualify someone. I would say with the changes that were made, almost 2 years ago, where how lenders calculate student loan payments has changed. It used to be that lenders automatically had to count a flat 1% of their outstanding loan balance. And now that isn't the case. It's 0.5 or, whatever their set payment is. So I would say that with those changes and then with the increased DPA amount in the designated counties, it can help more clients to qualify for programs, even if they do have student loans. Our Homeward Bound program and the HFA Advantage program does have a max DTI back-end ratio of 50%. So I would say, even though you have clients who do have student loans, and they are interested in buying a home, have them talk with the lender, because we have seen it where people who do have student loans, they've been able to use our programs, and it's actually been a big help to them because most have had difficulty saving for a down payment and closing costs. And so using our programs does help them tremendously.
Okay, and the last question, Lakeisha, are your loans assumable?
So our DPA is not assumable, but the first mortgage will follow FHA, VA, or USDA guidelines, or the HFA Advantage will follow Freddie Mac guidelines.
All right, great. And I see my colleague from Freddie Mac, Monica, jumped in here and put the link in for the QR code for the survey. So like I mentioned earlier, if you didn't have a chance to take a picture of that with your cell phone, there's the link. We really, really would appreciate your feedback. That's how, we do our jobs better by, getting the information from you that, what you feel was, relevant and what you didn't like. And, it's anonymous, so you don't have to think that if you say something bad about me, I'm going to, show up at your house and ask you why. You just, don't be afraid to put it in there. So this has been a great, great webinar. We really, really appreciated, the interaction. I know Lakeisha and I sometimes do these, and our audience doesn't, partake in questions and answering. And Mitchell and Pearl, thank you for jumping on and defining your questions. That really helps us too to get your feedback and your opinions on what we're doing. So we really appreciate it. And Ella, thank you for your association. We appreciate your partnership. And we know we're in overtime now, so
Jim,
if you have any other questions, please email them to us. We will, get back to you in a timely fashion. So
I have a question. Can you answer that about status change?
A status change regarding what, Pearl?
Chair, I said, when your status change, can you be considered first-time home buyer even if you already have a property? Let's say, people's situation.
And Lakeisha, then if they have a property right now, how does New Jersey housing handle that? For,
So
what status they are?
Right. If they currently own a primary residence, then they wouldn't be eligible to use our program. They have to be a first-time home buyer where they haven't owned a primary residence in the last 3 years. But if they are, let's say you have a client and they're selling their home and they meet the requirement or the exception of.
I'm talking about you have a home, okay?
Mm-hmm.
They have a home together, and then they status change from married to whatever legally, okay? Would that person be considered a first-time home buyer? Even though, let's say, during the agreement, the home the person get to keep, would that person still be considered a first-time home buyer?
If they were on the mortgage or the deed, then no. But again, I was going over some exceptions to that rule. So there are some exceptions for one of our programs. So if they're looking to use our first-time home buyer program, and even though they may have owned a primary residence in the last 3 years, so if they are a qualified veteran, they can use a program if they don't own a primary residence at closing, or if they're buying in an urban target area. So a case like that, that's one where you're going to reach out to the lender because there are some additional one-off pieces of information we would need to ask. We've seen situations with husband and wife where they divorce or separate, but maybe one of the persons was never actually on the mortgage or deed. If that is the case, then that person would be able to use our program, and they technically would be considered a first-time home buyer because they weren't on the mortgage and they weren't on the deed.
So as long as you are on the deed, even though your status change, you cannot be considered.
Correct, because deed is connected to ownership.
No problem.
Mm-hmm.
All right.
Thank you for your question.
Yeah, thank you, Lakeisha, for that clarity. Ella, thank you for letting us go over time. Do you have any final comments to your association members?
Not really. So the recording will be up on the website. I will let everyone know and email everyone that registered that like the link, and then that it's already up, so you guys can still access, so you guys can like rewatch everything and like access the slides that was used today. So thank you everyone for being here and for your patience.
All right. Thank you, everyone. Have a great day.
Thank you. Have a
Thanks,
great day and a
everyone.
good
Have a great
holiday.
day.
Bye-bye.